Welcome and thank you everyone for joining us. Today we're very fortunate to have James Check. James from Check on Chain is one of the world's foremost on-chain analysts. He's someone who really embodies simplicity on the far side of complexity. You know, he can take very complicated on-chain metrics and break it down to language that we can all understand. So great to have you here, James.
Thanks, mate. It's good to be here.
And today's session is going to be very Bitcoin focused. In James's opinion, Bitcoin is the only way.
That's where the signal is, mate.
Yeah. And so it is going to be not focused on alts, just giving us tools to read Bitcoin markets. So the purpose of today's session is to help give you those tools to read what's happening in the Bitcoin market on chain. And help you to consider in advance what you'll do if Bitcoin reaches certain metrics and according to your investment type. So if you're a long-term holder, if you're someone who wants to take money off the table at the top of the cycle, James will give you those frameworks to help think about that. So it's going to be pretty conversational. James has some charts that he can share after, and I will share after. But for now, it's just going to be pretty fast and loose. And
make it up as we go, mate.
Yeah, let James go down any rabbit holes he wants to. So without further ado, James, do you want to introduce yourself?
Sure. Yeah. So James Check, founder of Check on Chain. So I'm known for the on-chain side, but really I consider myself a Bitcoin analyst, right? I've been in this space for a long time. I bought the 2017 top, as many of us do, and then you learn something about markets fascinated me. I was a civil engineer at the time, and specifically, it's a form called geotechnical. So geotechnical is everything to do with the ground, basements, foundations, tunnels. And the merge between that and markets is there's lots of risk, there's lots of uncertainty, and there's lots of incomplete information.
You were saying something to me just before about the metro
station,
and the Combank buildings.
Yeah. So Martin Place Station, the metro, that was the last project I did in Australia as a civil engineer. So I designed the hole and the tunnels. I have no idea what they put in it until I walked through it recently, but that was the last thing that I designed. But that project, for example, I think, I might get my numbers wrong. I think it was like 180 million kilograms of material you've got to excavate. And we had like 7 boreholes, which are as wide as this microphone, to design that whole thing. So there's a lot of like, yeah, that's about right. And there's a lot of gut feel. Markets are much the same. So I fell down the market rabbit hole. Bitcoin was the first thing I ever bought at the top. Lost a bunch of money trading into every altcoin under the sun. My spreadsheet of 10 grand became 10 cents, right? And then when it finally halved again and I'm down 99.999%, I thought, okay, I did something wrong. So I went back and at the 2018 bottom, I read the Bitcoin white paper for the first time. And I was like, penny drops. And at about the same time, on-chain data was starting to be really developed. Coinmetrics came out with the realized cap, which is the very first metric. That actually just hit $1 trillion. And for reference, the realized cap is, in my opinion, the most important Bitcoin metric. It values every coin in the supply at the price when it last moved. So if you invested $10,000 back in 2019, that's saved at that $10,000 price point. So it's saved at the value when you invested it. And what's really neat about that is it shows us the collective wealth that we have stored in Bitcoin. Time adjusted. So the coins that I bought in 2019 and 2020, they remained at that price. And the ones I bought yesterday remain at that price. So it's kind of this macro view of like how much money have people actually invested in Bitcoin. This idea fascinated me. And again, it just hit $1 trillion, which again is a pretty remarkable milestone for a $2 trillion asset. We've got $1 trillion worth of real measurable capital stored in it. I did 3.5 years leading the Glassnode analytics team or building. I was employee number 8 and I was the analysis team for a number of years. Built that out. And then for the last 18 months, me and my best mate have been spinning out Check on Chain. So it's been our own business. And again, I consider myself a Bitcoin analyst. The on-chain side is certainly my specialty, but it's by no means the only thing I look at. We look at derivatives, we look at spot. I'm looking at the ETFs. I'm looking at how Bitcoin markets trade, and we're very fortunate in how much data we have. We're just stitching the puzzle together, right? And if you can see investors buying the high and paying a high interest rate in futures markets, some other guy who's been around for 5-6 years, he's also selling at that point in time. So you see all these like confluences where human behavior, and at the end of the day, Humans, we're herd animals. We do the same thing based on fear and greed, no matter what the market, no matter what the asset. We just happen to be able to visualize and see it really, really clean with Bitcoin data.
Yeah, great. Well, on that note, let's start stitching. So I guess starting at a really high level, Bitcoin has followed this 4-year cycle. There's been a couple of theories put forward about what's driving that. Halving events, business cycles. Explain that for us, and also tell us a bit about what's going on now in relation to that 4-year cycle.
Yes.
Does it hold? Have we decoupled?
It's one of the questions I get the most, probably second only to when top.
Yeah. When Lambo.
When Lambo, yeah. So the 4-year cycle is an interesting one because there's no question that Bitcoin has clearly followed this pattern. You can obviously anchor it to halving events, and a lot of people do. I think, generally speaking, there's a wide agreement that the halvings had a lot more of an impact back when, because you're cutting 50 to 25. It's a meaningful cut to issuance. These days, whether you measure on trade volume, whether you measure on just the sheer size, open interest, on-chain volume, whatever it is, the mining side, and I've got some charts on my website where if you can look at all the different volume metrics, spot, futures, options, ETFs, and you can turn them off one by one, and it will slowly adjust the scale, and you go down an order of magnitude, and then another one, and then another one, and then another one, and then you've got to zoom in 4 more times, and then there's this tiny little line down the bottom that is issuance. Okay. So you've really got to squint with your glasses on to see issuance relative to everything else. So I don't think the halvings drive the market cycle. In my view, look, there's business side, there's all sorts of elements, but I've actually been completely rethinking what I think about the cycles. I actually think there's been 3, and I think we're in the 3rd one as we speak. The first cycle, in my view, went from Genesis all the way to the 2017 top. And the way I would frame that up, in almost all metrics, you can look at things like transaction counts, active addresses, you can look at things like profitability, choose your metric, the way Bitcoin trades relative to the 200-day moving average, all this stuff. If you envision the world before 2017, we didn't really have TradingView price charts. We didn't really have developed exchanges. It was very organic retail. I mean, people had to mail money to Mt. Gox in the early days, all sorts of weird stuff.
Had to convert to Japanese yen.
Totally, right? So it's just a whole different animal. There's no institutions. There's no hedge funds. There's no derivatives. There's no stable coins. So it's this very organic, retail-driven people responding to Bitcoin as this new thing. It's a brand new thing. We've never seen anything like it. And we're talking about the earliest of early adopters. The 2017 top, it became a household name. Everybody, that's when I bought. That's when I found out about it. Everybody has now heard of Bitcoin. Some of them might have traded it. Some of them might have traded altcoins. There's been this all right, now it's a thing. And then as it does, it dies, right? It goes down 80%. Everyone says, it's over, it's finished. And that middle period.
Were those the first Bitcoin is dead headlines?
No, there was many of them before that.
Okay.
No. The Bitcoin obituary started a long time before that. But that 2017 all the way through to FTX blowing up. So 2018 through 2022, that's what I believe is the second cycle. And if you look at any metric, and I like to use the Mayer multiple, which is just the price divided by the 200-day moving average, because anybody can just calculate that in a spreadsheet, but it's the same with many metrics. 2017, that whole era was very organic. It found support at natural levels. It made sense. That middle period, 2018 to 22, boom bust. We went straight down and then we went straight up. And these are high amplitude moves. The way that price just ripped to the upside and then collapsed to the downside over and over again, it was very linear in one way. If you think about from COVID all the way through to the top, it was just one straight line, right? It just didn't stop. And then we had a major correction in the middle, which wiped out a lot of people in mid-21. Then we ripped straight back to a new all-time high, and then it was just a straight line down until FTX blew up. So really, really just high amplitude moves with leverage, by the way. You've now got derivatives with 100x levered coins, right? Now, the third cycle, which we're in at the moment, very distinctly started when FTX blew up. We have flushed this industry out of all of that early day cowboy-like leverage. There's a lot of bodies, right? A lot of firms didn't make it out the other side. And a lot of people, a lot of retail traders particularly, just said, I'm done. I'm never coming back to crypto again. The narrative was Bitcoin's dead for a decade. And then the ETFs come live. And then we start seeing, Saylor starts really buying. And then we're seeing more of these treasury companies. And if you think about what this cycle has been, we've been chopping around at 75K, 50K for 8 months. That's $1 trillion market cap zone. Roughly 50K is about $1 trillion. In 2024, we spent basically a year going sideways and saying, yeah, we're $1 trillion asset now. And every single dip was bought. The German government offloaded 50,000 Bitcoin and the market went up through it, right, at 53K. The ETFs are live and they just continue to just passively take in like $1 billion inflow days. Like, oh yeah, it's another billion. You know, like the whole market cap was 200 billion at the 2017 top.
So does that mean everyone's, I mean, not everyone, but the majority is agreeing that it's worth $1 trillion?
Totally.
At that
I believe so. So we prove we're $1 trillion. And if you actually go back to 2021, and this is actually, I think, quite an important point. In 2021, we got to $1 trillion market cap, 50, 60 grand. And then we got smacked down to 29. And then we tried it again in November. And then we had the 2022 bear market that took us to 15K. So the market said no. After we flushed out all the degenerate leverage, next thing you know, we're trading up to $1 trillion and we stayed there and every dip was bought. So we kind of proved that Bitcoin is $1 trillion asset in 2024. Now the question is, how many trillions? How many more? So we went straight from there to 100K. That's 2 trillion. We spent 6 months chopping around. Yeah, we had a correction around Liberation Day, but straight back up again. The market's now going, yeah, you know what? It might be worth 2 trillion. How many more trillions are we going to add to this thing? And it's starting to price discovery its way up. So
and people are comparing it to, you know, the realized cap of gold, say.
Totally.
And thinking, oh, we're still a fraction of that, and that's where we need to be as a...
Bitcoin's 10% of gold's market cap. What's 10%? Why don't we go 20? And once you get to 20, what about 25? Oh, we're a quarter. Let's go 50. And then once you get to 50, it's like, let's go. We're going all the way. So I think this cycle is much more structured. It's so structured that people are bored, right? We've had 2.5 years of like 100% returns over the year to date. So, you know, we went from 15K to 40K in 23. Then we went from 40K to, I think we closed the year like a 95K or 100K or something. So there's another 100% gain. And here we are trading at 120K and people are bored and think the cycle sucks. So this is the third cycle, much more structured, much more institutional. The fact that we've chopped around at $100,000, $2 trillion market cap, absorbing several $1 billion a day of sell side, and the ETFs just taking a casual billy and no one cares, shows you what has changed in this market cycle. So
to your point about boredom, we certainly see that at the exchange where, you know, it's like that meme, the stick figure poking Bitcoin and saying do something when it's going sideways. I mean, our business clients are still trading, but the retail comes in and out when it moves in either direction. So there's a funny phenomenon where if the price goes up, if it goes up fast, we get a bunch of inquiries about buying, you know, buy higher, sell higher, I guess.
And we will talk a lot about this because this is literally what on-chain data is just magic for, because we can see that happening. What we see is people do get excited. We are herd animals. First and foremost, it doesn't matter if it's Bitcoin, replace Bitcoin with wheat or, you know, oil, you name it. You name your asset, people will do the exact, Tesla, people do the exact same thing. They get excited when the number go up, and they get too excited when the number's going up a lot, and they buy high. And then what happens is they hodl, they become community members, and they hodl this thing until it goes down enough, and they all sell in a loss, and they crystallize their losses and go, I'm done, I'm finished. They all sell at the exact same time. So for me as an analyst, we can see when people move their coins on chain. And what happened, and by the way, you can see this in futures markets and, you know, ETFs, it doesn't matter, all the same behavior, just a different metric. We will see at the bottom of a dip, without fail, ETF outflows. We'll see funding rates go neutral to negative, and we'll see on-chain people taking really big losses. You'll see all of these things at the exact same time, because the people who bought the top and were very excited and thought they were making a great decision make the wrong decision all on the same day and they capitulate. For me as a hodler, that's where I step in, because now I'm buying my sats. It's definitely not at a premium anymore because you're seeing top buyers getting flushed out. And they
really
always do this.
That's actually quite a good segue into the way that you think about Bitcoin markets and the tools you use to kind of pick those tops and bottoms, whether they be local or cycle tops. I think this would be really valuable for our customers to kind of understand how you read the tea leaves. You know, what metrics you look at.
The voodoo,
The
yes.
voodoo, yeah. And maybe and maybe get some insights into how it's not actually voodoo, it's looking at human behavior and
voodoo or astrology. I get this a lot. And look, at the end of the day, I'm a big advocate for like everything's a tool. Markets are just information. And I think the most important thing that people don't think about is that nobody can predict the future. People love to look for predictions. I have long since given up on pretending or even lying and saying, yeah, I can predict what's going to happen next. I have no idea. No one does. So the sooner you let go of the mentality that you can predict anything, the better off you're going to be. Instead, flip it around and say, I have a series of information. It could be price, it could be technical analysis, it could be on-chain data, it could be spot, it could be futures, it could be all of the above. And I'm in the all of the above camp. I just take in the information. I say, well, what is the message that it's telling me? Because I can't predict the future, but what I can do is predefine what my decisions are going to be. That's actually the only thing I can control. I can't control the market. It's like the tide. If you fight against the tide, you're going to get sucked out to sea. What you're better off doing is saying, and a great example of this, when we first got to 100K in November, December last year, in that December, January, February period, we're chopping around 100K, that kind of zone. I was writing quite a bit about the just sheer amount of sell side that was coming from hodlers. People have held their coins for a long time. There was tons of it, billions and billions of dollars a day. And on Twitter, you look at it and people are saying, why isn't the price going up? Why aren't we bullish? And I was like, because there's a lot of sellers, guys. And people just don't like to believe this, but this was happening.
People sell Bitcoin.
Can you believe that? Yeah. In fact, every price has a buyer and a seller. So from my perspective, I was saying, look, there's a lot of sell side here. And again, I'm not predicting the future, but on the way up, right? So we've had the election in the US is coming in. We went from 70K basically straight to 100. And we left what I call an air pocket. And it's this zone between, it was 86 and 75. That price range, very, very few coins changed hands. We didn't see much trade activity because it shot straight through. We didn't spend enough time there chopping around. Now, I can't predict the future, but I was saying to my subscribers, look, guys, just be careful because I've seen enough of these air gaps, these air pockets in my time. The market wants to go and find out, more often than not, it just wants to go and find out, all right, you loved it at 75, now you like it at 100, because remember, all that sell side has a buyer. So now you've got a bunch of people who've bought at 95 to 100. And there was a point in time in February where I talked about the realized price before, pricing every coin when it last moved. 52% of all dollars that had ever been invested in Bitcoin had a cost basis above 90K.
Wow.
It's a crazy stat.
Yeah.
Now it's over like, I think it's like 65 now. So a crazy stat of how many people are now trapped is the wrong word, but have a cost basis at a high level. And I said, look, I can't predict this is going to happen, but just prepare your own decision framework. Just think about it in advance. What would happen if the price went to 75? What are you going to do? And what I don't want I don't want people to be a deer in the headlights. So I was talking about, hey, we might go to 150K. That's like where a lot of levels are saying overheated. We could definitely get to 150 at that point in time. But I said, we also might take an excursion to 75. And this is not saying that we're going to go there, but have a framework. So I was already prepared. If we go to 75, and we did go to, I think we went to like
April.
Yes, we went to like 74.8. And again, it's not because I predicted it, but I had already made my decision of what I was going to do. I was going to empty my bank account. And what did I do? I emptied my bank account. My mate was walking past me, and I'd literally just like emptied everything I had. And he goes, mate, you look a little bit white. And I said, I'm not going to lie, mate. I kind of spent more than I should have.
I remember that time because I had my finger over the buy button at 74.8, and I wish I'd met you a few months earlier because I would have had the conviction to go through with it. But instead, every day that goes by, my boss reminds me of
you could have, you should have, you would have.
Made,
oh,
that
totally.
I was talking a big game about.
And this is a great example of like the psychology. So again, it wasn't a prediction. It was just simply saying like, what am I going to do? And because I'd thought about it in advance, I already knew my plan. And the worst thing you can do is deviate from your plan. If you make a decision, especially if you do it, it's very hard to make a decision when the market's doing this and water falling down or ripping to the upside. What people tend to do is they change their plan because they're like, oh, it's going to keep going up. And then they miss, if they've got a plan, I want to sell at this price. And it gets to that price and then go, oh, but it might go higher, and they adjust their price. So
do you think they're taking in new information though?
No. Fear and greed.
It's just easy to rationalize once you get to that point.
So it's much easier to think cleanly when the market's doing this and going nowhere. So that's why I was telling my subscribers at 100K, there's a lot of sell side and there's an air pocket. Just keep it in mind, because even if your decision is to do nothing, if we go to 75, you shouldn't be surprised, because it's just the market doing what the market does. It's just trying to find that demand. And more often than not, if a decision you're making, and this is just like common in all markets, if your stomach is churning at the time when you do it and you want to be sick, more often than not, it's actually a good decision. When it feels fantastic, it's usually a bad choice. So, for example, if it's ripping to the upside, me as a Bitcoiner, whilst I don't plan to sell any this cycle, it depends on the price. Like if it goes to $1 million, it's coming down hard. But assuming we have a normal cycle and it continues to trade the way it is, I'm probably not a seller. But if I was to be a seller, it's going to feel absolutely awful. It's going to be trading like 150, 160, 180K, and I'll be like, I don't want to do this. But that's probably a good decision. At the end of the day, it's probably a good decision. And likewise, at 78, even me, a professional analyst, or at least I consider myself a professional, I try to be a professional, we're trading at 74, and I'm like, my stomach is churning as I send it. I'm like literally white, but like I made that decision months in advance.
With a clear mind.
Stick to the plan. Don't change the plan, because when it's water falling down is not the time to start. You're in the battle at that point in time. Don't go changing your plan.
But, I mean, how do you know whether that's a local dip or a local high versus the high or the...
It's a very good question. I say this all the time. There is the top and there is a top. And there are many A tops on the way to becoming the top. And every the top starts as an A top. And likewise for a dip, every bear market looks at the start of a bear, that first sell-off. In market terminology, you often hear it called the shot across the bow. And it's like from old naval when they would fire the cannon. It's not intended to hit the hull, but the cannonball flies close enough that they know that you're serious. There's a sell-off that happens, and you can see it at the end of 2017. That first sell-off that took it from like 20K down to 6K. In 2021, in my view, is the mid-2021 sell-off. We went from like 55 to 29.
Was that Luna?
No, the first one, middle of the year. So before the second all-time high. Yeah. I believe that second all-time high, that's a whole topic to itself. I think that's actually the first all-time high we've had in a bear market. I think we were in a bear market at that point in time from a sentiment standpoint. Huh. But anyway, that first sell-off, it feels different. It has a different character. And you'll actually see it a lot in on-chain data. Realized losses go through the roof. And most importantly, unrealized losses. So when I talk about on-chain data, there's lots of ways we can slice and dice it. But I'll often talk about unrealized profit and loss and realized profit and loss. Unrealized shows me of all the people who are not transacting, how has their profitability changed? What's the value in their portfolio doing? And on those shot across the bow sell-offs, the unrealized losses go through the roof.
You've got a good, you've got a good chart on this.
Yes.
What's the name of that chart? So
there's a few. I mean, you can look at it just as like a percent of unrealized losses. So you can look at all the paper wealth in the system. So obviously you can see everyone's cost basis. Ignore the amount they paid for their coins. Just look at the delta between the price they paid and where the spot price currently is. So imagine, like I often say to people, what would you expect to see at a bull market top? You see a lot of people picking up the phone and saying, I got to buy this thing, right? I got to get involved. You see lots and lots of people buying at the top, and you see lots of people who bought a long time ago when no one wanted to buy in the bear selling. So when I go and see lots of realized profit coming from old money, lots of coin day destruction, it's telling me that the guys who've been around for a while and had the grit to buy at the bottom, they're starting to exit. When you see 3 and 5 year old coins coming back to life, you've got two things happening. They're exiting, and someone who wasn't around 3 to 5 years ago is starting to step in. So
would you consider them to be kind of smart money versus...
Correct.
Well, not
not so smart money.
But yeah. Like the less experienced.
The more, exactly, less experienced, more speculators, more price driven, right? Rather than fundamentals driven. So you're seeing this transfer of wealth from the old to the new. Now, what happens, speaking of A top and the top, in bull markets, there's dips all the time. But there's a certain level where bulls are like, I've taken a couple of punches, right? I don't mind if I'm down 5%, 10%, 15%. But when I'm down 35 or 40, that hurts. So you look for the point in time where in corrections, people go into unrealized losses, but they're not severe. This is the chart you were talking about. When the paper wealth in the system is mostly paper profit, people are willing to just let the thing run. And they might even step in and buy. But that shot across the bow sell-off, you've seen all the old money selling for weeks and months at a time. Then you get the shot across the bow sell-off. And everyone's going to go, it's just another dip. But what you're actually going to see under the surface is you've now got so many people trapped at the top, their unrealized losses go much higher than usual. And now it's like a shockwave. So no one wants to believe that the bull is dead. And by the way, this is how it has played out in the past. I'm very conscious that these things will evolve, and I'm living in a flexible world here, but you will see there's a very big difference between bear market starting dips and just a dip, right? We can usually recover from a certain amount of damage, but there's this threshold, an indeterminate threshold, but I've got a rough gauge on where it is. That's the kind of level where you go, ooh, this might be a little bit different.
Right.
So
you can take a few punches, but that's the KO.
There's one where you staggered.
Yeah.
And then once you're staggered, you're probably going down. Might take a couple more hits, but you're probably going down. So that's the right way to think about it. So there's a top looking for the sell side, but then when there's too much sell side, it becomes the top. And the top is usually, you don't know until you get that shot across the bow sell-off. And the really smart money, the people who were on holidays and they've just come back to their desk, they've seen the shot across the bow sell-off and they go, that's different. And then you always get a relief bounce. And that's when you'll see a lot of profit taken because they know.
And
they know it's
another
done.
3-year holiday.
Yeah, and that's it. You walk away, right? And you just let the thing find its level again.
So, I mean, the temptation as it's getting quite toppy is obviously to feel like, I realize it's getting quite expensive here, but I'm going to try and wait till the last moment to get the money out.
Yeah.
Like, if there's another 20% to gain from it, I don't want to miss out on that. It could be significant for my life. So what's the, what's the way to think about, the balance of the risk of getting caught with the bag, but trying to maximize your returns?
Yeah, it's really important. And I think the most important thing to understand is, who are you? What are your goals? If you don't actually know what your goals are, this question is going to be impossible for you to answer. So, for example, a lot of my subscribers are retirees. And when I have conversation with them, they're saying, look, I'm long Bitcoin. I love Bitcoin. I'm a Bitcoiner through and through. But I don't have the time to do another 5-year bear market. I don't have the time to do it. I just can't. So I have to buy myself some runway. So for them, their decision framework is actually quite simple. You're never going to pick the top. Picking the top is impossible. No one can do it. But what you can do is you can say, well, what are my goals? So for me, my 30s, I got plenty of time. What's my goal? My goal is I don't really want to buy the top again, because I don't mind if, my portfolio that's all paper gains becomes slightly less paper gains. I don't care, right? Bitcoin for me personally is an end game asset. And I personally buy and hold Bitcoin as my savings account. Its job is to pay off the mortgage in the next, 10, 15, 20 years, get the kids through a decent school. Like it's multi-decade duration asset for me. So I really actually don't care about what the price does in between here and there. I just want to accumulate as much as I can. And that involves not buying the top. So I also don't really want to just lump sum a fat chunk at the absolute pico top. So for me as a hodler, if Bitcoin is my longest duration asset, I just don't want to lump sum everything at the absolute pico top. But I do kind of want to have some cash to buy later on. So for me, if I'm just doing I got a daily DCA running that just goes indefinitely, I might switch that off when things start getting a bit frothy. Because what I'm effectively doing is just accumulating a cash balance without a capital gains tax implication. And then I can switch it back on when the timing is right. So for me and my journey, for my goal, I just don't want to buy the top anymore. It's very hard to beat daily DCA, by the way. You can codify as many trends and charts and indicators as you want. It's damn hard to beat daily DCA. The only way that I've found to do it is actually just not lump sum at the top and actually go a bit harder when it really pulls back. And again, it's not about timing the market. That's why daily DCA is great. Other people, the reason DCA is so powerful, and whenever someone's brand new to any asset, but Bitcoin especially, I will always encourage them to DCA, because you can make everything a positive. If the asset goes down, you're buying more next time you DCA. If the asset goes up, great, you're buying an appreciating asset. Well done. It's the exact same on if you would exit. If you DCA out in the exact same framework, I want to peel off 2% of my portfolio every week or then every day or whatever it is. If you sell and it goes up, great, you get to sell at a higher price. And if you sell and it goes down, well done, you sold the top. So it's a win-win no matter which way you do it. But having your goal in mind is actually the first step. If you don't know why you're even buying this thing in the first place, and you don't know what your goal is and you want to achieve, knowing why you entered is just as important as knowing why you're exiting. So frame those
it's
up.
refreshing to hear someone talk about the real world implications
Totally.
of Bitcoin. You know, it's a means to an end rather than
Totally.
an end in itself.
Yeah, and I genuinely do view Bitcoin as my savings and my long-term savings. And I actually really only have two assets in my portfolio. It's Bitcoin and gold, right? MSTR, but that's a derivative of Bitcoin really. So it's Bitcoin and gold. Gold for me is and I really do view from a sound money framework, gold is my preservation of capital. I don't want it to outperform Bitcoin. I'd love it if it did, but it won't. But I know that if I put $5,000 in, it's going to be worth $5,000 in purchasing power when I need it. So for me, if the thing I'm really saving for, it's hard to do in this country, is a house. Getting on the housing market is tough. And Bitcoin might be ripping to the upside and I don't really want to liquidate it. And it also might be in a horrendous bear market and I don't want to liquidate it.
So timing's important.
Timing's important. So for me, Bitcoin's job is to clear the mortgage one day. Indeterminate, but a decade plus from now.
Okay.
Gold is there to, if I need the deposit, it might be that the housing market is in the right time. I don't really care. I price the housing market in gold. I price the housing market in Bitcoin. And by the way, if you want to, I've got a chart on my website that shows this, but the housing market in Bitcoin is in a horrendous depression. So, we hear about the housing bubble all the time. Well, in AUD, not in Bitcoin terms. So for me, gold is there specifically to be that deposit when I need it. It's going to preserve that capital. Bitcoin is there to grow it. So for me, that's how I think about those two assets. If I want to save money that I might need in 12 months, gold. If I need money I might need in 2 months, cash. If I need something that's in a decade, Bitcoin.
So to just kind of summarize how you look at the market on chain, what kind of things you're looking for, which of your charts people should be looking at to kind of get a feel for that. You said that it's old coin holders that are selling. That's an important metric. Is there kind of an 80-20 rule where some metrics are more important?
Totally. Oh no, there's thousands and thousands of metrics you can look at. Realistically, like as a starter pack, just get your head around 3 metrics. One's called the realized cap. We talked about that before. It's the on-chain market cap. Basically, if the realized cap is climbing, it means 2 things. And you got to always think in markets. You always have to look at both sides of the story because they're always true. When the realized cap is climbing, it means someone who bought their coins at 10K is selling it at 100, or bought it at 100 is selling it at 120. There's a capital gain there. But that also means if you bought at 10K and sold at 100, some other dude came in with 90 grand, extra money. So he's injected 90,000 extra dollars into the market. When you buy the top and then you sell the bottom, you kind of destroyed capital. So that's a capital outflow. So the direction, trend, and gradient of the realized cap tells us, is Bitcoin growing? Are more people saving capital in it? But simultaneously, are we seeing profit taking? Because that sell side is coming from somebody. And the more it increases, the older and the lower those cost basis coins are.
Are we seeing a handover from experienced
Correct.
Bitcoiners to
Correct. So the first thing to understand is the realized cap, and the reason it's the backbone. Everything else in the on-chain world that, in my opinion, is valuable is a derivative from that idea of that buying, selling, profit taking, profit losing. Now, if you look at that almost on the first derivative, not quite, but if you look at the first derivative, the gradient, how much that is changing day to day, and you can break this up into old money, the whole market just indiscriminately, or people who've recently bought, short-term holders, everyone, long-term holders. We can use these things called cohorts, but it's basically looking at which type of person. You can look at the first derivative of the realized cap, and that's what we call SOPR, the spent output profit ratio. Show me the average profit or loss being locked in today. So imagine what we're going to see at tops. If people who bought 2 weeks ago are making fat gains, people who bought 5 years ago are making fat gains, and on average, everyone's making fat gains, kind of stuff you don't see at bear market bottoms, it's kind of stuff you see at tops. So that's a good indicator that if everyone's making money, you might remember from 2017, there was those shirts, everybody's making money except you, and here's why, something like that. When you see those headlines, the bull market is bulletproof, getting kind of toppy. Why do people take profit? They take profit because they're paper gains. No one takes profit when they're 2% above their cost basis. When they're 20, 30, 50, 100, 200% above their cost basis, kind of juicy. So that's what we call the MVRV ratio. It's the ratio between price and the realized price, or various cohorts. So really, there's three metrics. Is capital coming in or out of the system? Realized cap. What is the paper gains or losses in the system? MVRV. What are the profit and loss being locked in? So now you've got a story of aggregate, incentive, action. Those three, if you can get your head around those, they're my Swiss Army knives. I don't need any other metrics. But when people are taking lots of profit, it's because they're in a lot of profit, and it's also because funding rates are really high and ETFs are going to be taking in way too much money. All these things line up at the exact same time because humans are herd animals. They may express it through the ETF. They may express it through a levered long position. And it works on the downside too. Maximum losses means that all the speculators are gone. It's only hodlers that are left. People start capitulating. They buy the top, they sell the bottom. It's beautiful.
Okay, so with that framework in mind, with some interesting metrics to keep an eye on, right now at this point in time, what are you seeing?
Yes, we're in a very interesting position in the market. So everything up until about April this year, I would generally frame as extreme. I mean, the whole market's been very healthy. If you look at it on log chart, it's just up, sideways, up, side. It's this beautiful stair-stepping pattern, very sustainable. So when we go up and then we trade sideways for 6 to 8 months, we build a lot of support. And think of markets as a confidence machine. I'm pretty confident. We talked before about that $1 trillion zone in 2024. We kind of proved Bitcoin's $1 trillion asset. I think it would take a real nuke of some form, something really nasty, and it's probably only temporary, to take us below that level. So the market has a lot of confidence that 60 to 70K zone, we belong there. 75, we came down, we tagged it. Next thing you know, we're at 120, So we also have 100K. That's another zone where we formed quite a bit of confidence. We're at 118, I think, at the time of recording. Where do we go from here? There's a lot less confidence. So since April, we've started to meaningfully transition away from this very healthy, spot-driven, ETF-driven, just people actually buying spot Bitcoin. Since April, futures open interest is through the roof. Options open interest is through the roof. Treasury companies are crowding up with all sorts of weird and zany ways to, lever up and buy Bitcoin. So stuff's starting to get a bit aggressive, a bit levered, a bit speculative.
And that's to say that there's a lot of people who still believe this bull market has
bulletproof
somewhere to run.
Yes. And so now, if you think about that, you've got the ETFs, which are providing this very stable, $1 billion passive bid, just indiscriminately. And I'm in that camp. My retirement, I use SMSF. And for my purposes, the ETFs are just a really convenient way to do it. I don't care. I don't care what the price is. Money comes in, hit buy, end of story. So there's a lot of people doing that. So they're like this passive background noise. You've also got the treasury companies, which are like a very aggressive spot bid. Just buy as much as you can, sell as much equity as you can, buy as much as you can. There's only so long that party can go on for. So 6 months ago, it was quite difficult for me to construct the bear market scenario. It was very healthy. Now it doesn't take a lot, right? We're seeing a lot of leverage in like real crypto native degenerate exchanges. Options are through the roof, which again is a bit more sophisticated. But you've got a lot more leverage creeping in. So this creates a lot of upside potential, but it also has an unwind. There's a hangover. So I don't think we're at the top yet, but I do believe we've switched over into what I tend to call the euphoric bull. This is that final stage. And you mentioned earlier, this is where people adjust their plans, because the final stage, this euphoric phase of the bull, historically speaking, in all markets, this is where stuff happens really quickly. And if you go back to 2017, this is where we go from 2K to 20K in like a very, very short span of time. It's where the market can go really quite right tail, just get to the long tail of things that happen, but it doesn't stay there. So this is the phase I think we're moving into. Remains to be seen what kind of color and stuff goes around it. The longer and the slower it takes to do this, the more support we build along the way, the better it is. But also we're starting to get to that point where people are like, it's bulletproof, I've got to lever up. Here's a good example I've been using. I've received 0 calls from like muggles out in the world who have no Bitcoin saying, hey, should I buy Bitcoin? I've had none this cycle. What I did get is when we had the Liberation Day, went to 75, then we went to 110, and we chopped around for like 2 weeks. In that 2-week period, I received like 12 phone calls and messages from people who are existing Bitcoiners, all asking me what's the best way to lever up to buy more Bitcoin. How should I borrow against my stack? That's where we're at. You know what the best time to do that was? 20K and 30K and 40K, not 110. Now, that doesn't mean we can't go to 150 or 180 or 200. We can. But the odds are increasingly not in your favor because everyone else is doing the same thing, and leverage bites both ways.
And what happens when you pour all that leverage into the market?
Well, you get an unwind, right? Because, like, you know, everyone says, oh, but you'll do it responsibly. It's like, you might do it responsibly, but that guy's not doing it responsibly. You know, like, he's going max levered long. And here's a great example. We were chopping around 110 for like 2-3 weeks, and then we went straight to 120 or 123. I was talking to my sub saying, look, guys, and very rarely do I worry too much about liquidation levels because it's I don't really care about intraday stuff. I don't really care. Intraday stuff is noise. I try to look at what's going to happen over a slightly longer period of time.
Sure.
But in that case, I was zooming in and saying, look, there's a stack of people between exactly 110 and 120 and the number of liquidation levels. I'm like, this thing's going to go just straight through it. It's so obvious. And what set me off on this is I was looking at funding rates, which is the interest rate that futures traders pay. And I don't recall, there's very few times in my career and time looking at this, that I've seen the market like at the all-time high and funding rates be negative or neutral, which means that shorts are actually paying a premium to be short. And I'm like, I can't see any relative value trades. I can't see enough cash and carry. It has to just be like naked shorts. People are just short the market. They think it's a double top. And I was like, they're wrong because the market just looks like the price chart looks like it wants to go home. Like, guys, just be ready because if we hit like 112, it's going straight to 120. Next thing you know, straight through it, right? So people just seem to want to go short this market. I'm like, you don't have tops when people are short. You have tops when people are getting long because then there's no buyers left.
Interesting. Yeah, great. So you sort of talked about ETFs firing up. There's some policy changes which might be adding some tailwinds amongst all the leverage. You know, in the US, they're talking about opening up retirement funds to invest in Bitcoin. You know, talk us through what you think happens once they open the floodgates there.
Sure. I mean, like the general regulatory environment is just far superior than it was, 6 months ago. It's in a far better spot. I think really at the end of the day, what's the most interesting policy change is actually how long it took them to realize that Doge ain't happening. That to me is like the most interesting thing. So, the Trump administration came in and they were very much about we're going to, cut spending, balance budgets, blah, blah, blah. And for anyone who's got their head screwed on, they're like, all right, good luck with that. Let's see what you can do. What they last 5 months before Elon's out and they've just given up. It's so abundantly clear, and I think there's a concept in just social behaviour. Everybody knows that they can't cut spending now, right? Everyone kind of pretends that they might be able to do it, and they're a bit hopeful and blah blah blah. But now everyone knows, and everybody knows that they can't. So now everyone is acting accordingly. And I actually did a piece yesterday called "Bitcoin's Too Volatile." And the idea was trying to counter this FUD that there's two things that you hear all the time. That Bitcoin's too volatile, and the other one is that it's only valuable because it's gone up a lot in the past. And basically what it is, I try to help people explain, like, if you adjust your benchmark and look at Bitcoin as your anchor, right? I use gold as the meter of value, compare everything to gold. If you're not beating gold, you're kind of getting wrecked because gold is the inflation rate, in my opinion. Bitcoin is one of the few assets that's beating gold. And when you price everything else, equity markets, specifically the US government long bonds and fiat currency, if you price those two in gold, they look like an emerging market currency going into the gutter. And that's kind of because that's what's happening. So the world is now realizing that all of these governments are bankrupt and they don't have a choice. They have to grow their way out, which is another word for we're going to print a lot of money and keep the system going. So they have to do it, and Bitcoin is just such an amazing asset to absorb that excess liquidity. I think a lot of people get caught up thinking that, and this is a very, very common thing in markets, people take short-term information and they extrapolate it over the long term, and they think it's going to happen now. So they get a piece of information like they're going to have to print a lot of money, and they go, oh my God, I got to buy all this Bitcoin right now, because that will play out. Like physics determines that that's going to happen. but it's probably not going to happen in the next day. And this is why people get stuck on the sidelines expecting an Omega candle that just takes us to $1 million. We're going to go to $1 million, but it's going to take a lot longer than people think. And the other thing, so they take long scale information, they plug it into their short term. And the other thing people do is they look at the next red candle on the daily chart and they go, oh my God, it's over. It's time to go short. And they like extrapolate short-term stuff.
New round of obituaries.
Totally. It's very, very common. So on the regulatory front, it's no question, it's going to be more favorable. But at the end of the day, the only regulatory thing that matters is that they're kind of trapped and the bond market's in world trouble. If you price bonds and fiat in gold, they're getting wrecked. If you price most things in gold, it's getting wrecked. Bitcoin's kind of the only thing that's really escaping the gravity, and some of the highest flying tech stocks. That's about it.
Yeah, a lot of political pressure on the Fed to turn on the money printer and
well, I mean, we're in this kind of fourth turning type era. I mean, like, is the Fed going to be independent at the end of this? Maybe not, right? Maybe not. We're seeing a lot of movement there. I don't think they're going to get Jay Powell to resign, but there's a lot of rumbling in it. The fact that we're talking about this is a sign that, like, you know, I've put out a tweet some time back. It was a bit controversial, but it was US equal EM, right? The US is kind of trading like an emerging market. So is a lot of the developed world. So it's going to be it's a fascinating macro environment. For me, as I'm a professional Bitcoin analyst, but my kind of hobby is studying the macro side. That's why I find it fascinating. It's the unsolvable, endlessly evolving puzzle. So I find it, just as a student of history and markets, fascinating to keep track of it.
Yeah, it's interesting. One social dynamic in the Bitcoin world is that you've got a bunch of single issue voters, or
totally.
People who just care about one thing, which is the price, and the whole kind of world that we live in comes next.
Yep.
And
well,
to your point earlier about the real world value of Bitcoin, I think there's not enough emphasis put on the interplay between like what drives prices and actually what are you going to use it for in the future if your
totally
society.
You know, I can buy 10 times more house with my 2019 Bitcoin, right? And I certainly can't buy 10 times more house with my Aussie dollars. So, you know, it has to have a real world purpose and a function.
Yeah, right. And so who's, like, what type of buyer is buying Bitcoin now? Is it hodlers? Is it traders? You know, like what do you, you know, when it comes to the next time when there's a big sell-off event, what proportion of all Bitcoin holders would you say are going to sell and get out versus kind of understand the cycles now and are just going to hold it?
Yeah, so it's a really good question. So, I mean, there is a bit of speculation here, but there's no question that there's two things that are happening. The holder base and the type of investor is definitely changed. You do not chop around it at 100K with billions of dollars of sell side with a couple of retail hodlers earning their salary. It's not practical. It doesn't make sense. We are seeing very, very serious institutions, and you know, it's a bit old at this point, so don't quote these stats, but it would have been probably, I don't know, maybe 12 months ago or 8 months ago or something. I ran this. I looked at all the 13F filings for all the institutions buying these ETFs, and at the time, about 25% of them were institutions that I think it's 100 million that they have to file these 13F, so they're meaningful size. And if you look at the spread of who was buying and what their portfolio makeup was, you had a handful of like the smaller firms. Some of them are like 100% Bitcoin. They're obviously like a Bitcoin hedge fund of some form. But most of them in that like smaller size category, 100 million to I think up to $1 billion was my cutoff, which again,
just
$1 billion.
Small numbers.
Yeah, just small numbers. A lot of those were like 5%, 10%, 1% in that ballpark. Maybe 10, some were 100, but very few. Then you get up to the top end. And like most things in the world, it's a Pareto distribution. You've got lots of these small firms, right? 100 million to $1 billion. And they've got 5, 10, 15, 20%, 1%. Well, I think 1% was the average. Then you get to the big boys. And these are like the 100 billion, tens of billion, $1 trillion asset managers. And they've got 0.0001% allocated, right? And we're talking with that 0.0001% billion, 10 billion, 50 million, 100 million, whatever the size is. And then you're just like, okay, so these guys hold like 90, they're the smallest allocation as a portfolio of their portfolio, but the overall size is 90% of the capital of all of these 13F filings. And like, what happens if these guys go from 0.0001 to 0.0002, right? That's like a doubling of this pool. It's quite extraordinary. So that's the kind of scale that we're in. We've just got enormous buyers coming in. You're seeing some of the smartest minds, like the Stan Druckenmillers and Paul Tudor Jones are going like, I mean, Bitcoin makes sense. Even Ray Dalio is starting to come around, and the more of these credible, well-observed voices start to say the same thing, which is the government's kind of bankrupt and you kind of need to start looking elsewhere. This is why gold is doing so much better than most assets at the moment. I anchor a lot of my charts when I'm looking at like relative performance. I like to do 2020, start of 2020, because that's before the big print that we saw in COVID. And it's when most people will anchor their pre-inflation thought process too. So you want to see how assets have performed since then. But the other place I anchor it is to February 2022, when the US froze Russia's reserves. Because that was a point in time when sovereigns, multinationals, companies, everybody had to say, wait a second, my money in treasuries may not be safe. I have to look for something else, even if it's at the margin. And since then, gold's been doing tremendously well. So if you anchor from that position, Bitcoin and gold really do emerge as the only kind of assets that people can allocate to, because they're neutral, non-sovereign stores of wealth. So Bitcoin and gold are just in a very, very different world from that point in time, and they become the benchmark.
So is this, with all of these macro and policy tailwinds and reaching the point of the cycle where things turn vertical potentially, people are getting euphoric, that optimism just builds on optimism and everyone gets excited. Do you see this being, heading to quite a volatile endpoint?
I think the odds of more volatility is definitely higher moving forward, because we're in that euphoric stage. I'm very flexible. So I've got my certain levels. We mentioned MVRV before, which was the unrealized profit or loss. Because we know that people, like human beings, we are herd animals. We do the same thing no matter what the asset is, no matter what the stimulus is. Human behavior is the only constant in markets. What's going to cause people to sell? Paper gains. When their number gets big enough that they just look at their portfolio and go, I can finally buy the house. I can finally do that thing that I wanted to do. So when the number gets green enough, people are likely to sell. So because we can see where people have sold in the past, unrealized profit and loss, we can project forward. We can see everyone's cost basis, and you can say, well, where do we have to go for that cost basis to be in 2x or 3x or 4x profit? And where in the past have they sold those levels? So we can start to at least model out, where do we think, or at least from my perspective, my framework, where do I think the sell side is going to kick in? Because at the end of the day, bull markets don't kill themselves. They have to have sell side come in to actually put the top in. So we're trying to say, well, here's where people sold in the past based on their profit and loss. Let's project that forward and say, well, where can that be? So from that framework...
So with the disclaimer of, obviously not financial advice.
With the disclaimer of no one can predict the future, all we can do is say, where do we think people are going to behave a certain way? Where do I expect behavior to change?
So based on what we've seen in past cycles and from your knowledge, what does that range typically, or what does it look like in your mind for this cycle? Yeah,
so a way to kind of contextualize how I come to these numbers, obviously we're looking at unrealized profit and loss, and there's various other indicators. Mean reversion. Markets are mean reverting phenomena. When do we stretch the elastic band too far to the upside or the downside? In this case, if we get to about 130, 135, that's where we're getting into the profit-taking zone. That's where, statistically speaking, a lot of hodlers are going to be quite happy with the returns. Once you get up to about 150, 160, up to 180, and by the way, all these models, they're moving targets. And the reason they move is that the longer we go sideways, the more capital comes in. Let's imagine we have 8 months of sideways at 120. We've now built that confidence. Markets are a confidence machine. We're like, yeah, we kind of belong at 120 now. So the longer we're there, the more capital comes in, the more you can say, well, what if that's a floor, not a ceiling, right? And you start to, mean reversion. If you're allowing the average cost basis to come up, it's more normal. We're acclimatized to it.
You've got this concept of quiet and trending.
Quiet and trending. That's this like up sideways price structure. And the quiet parts comes from the volatility. It's been a very, very low volatility bull. Usually Bitcoin bulls are very, very volatile. And it increases the higher we go. We haven't seen that yet. We may not see it, but again, I've got to be very, very flexible because we'll see how things play out. Now, in terms of 150, 160, 170, 180, as it stands today, that's where things are getting 2 standard deviations, 3 standard deviations stretched away from the mean. In terms of some odds, ballpark figures 160, 170, that kind of zone, most of the metrics that I look at will be in there's only 10% of trading days that have been higher on a relative basis. So on a mean reversion framework, just imagine an oscillator or a sine wave, only 10% of that sine wave has ever been above those levels. If you start getting to 170, 180, you start entering the 4%, the 2%, the 1%. Now, can we keep going? Yeah, we could go to $1 million. Are we going to stay there? It's highly improbable, right? We might. We could go as high as we want. We may never reach these levels. But the odds that we get there and stay there are increasingly slim. But this comes back to that previous idea. Markets can get really wild towards the end. And the narrative is going to be that there is no top, and it is a new paradigm. Look at all these treasury companies. The Bitcoin can't go down. And I'm just going to be looking at this thing going, if we get to these prices, it's going to say, sure, that's true, that might happen, but also there's a 4% chance based on history that that's going to be the way it goes. So I don't know what's going to happen, but the higher we go, the lower the odds are that we stay there. But again, we can that's the working thesis. What has to actually happen? Well, first of all, the market has to get there. And second of all, we can then look at the profit taking and the coin day destruction. Are we actually seeing the sell side required to kill the bull? If not, if there's no sellers, price has to correct higher until it finds sellers.
Interesting. So with that in mind, if we sort of broke it into 2 archetypes, unless you have more, just to help the viewers think about an exit strategy. If we had forever holders and people who want to take some off the table, what would be the right way to think about how they play this next top?
Yeah, I mean, I think the most important thing, and I can only really speak for myself, is know who you are, what your goals are, and what helps you realize those goals. If you don't have a goal, you don't know what you're here for. So knowing your goal is actually the most important thing. And it's something that I think very, very few people do. A lot of people are just like, I'm going to buy and hold. That's fine. That can be a goal. There's nothing wrong with that. I literally just want to accumulate generational wealth, which is perfectly fine. So then the next question is, okay, it may be that you just daily DCA and you just never turn it off. Just keep cranking it out. And there's nothing wrong with that. For me, where I am in my journey, I've been around this market. I've seen this cycle enough that I don't want to be, I'm not trying to time the market. I'm just not trying to mistime the market. I don't really want to lump sum everything at the top. So, for us as a business, we sweep our free cash flows into Bitcoin. It's our savings asset as well. It might be, like for me, I will probably peel off my more risky assets like MicroStrategy. I think Strategy is a fantastic company. I think it's a fascinating story. It's taught me a lot. But I'm very aware that it is my risk play. And I hold it specifically as my risk play this cycle. I will probably peel some, not all of it off to give me that extra cash to actually go and just enjoy. It's the first time I've ever sold really anything for a meaningful profit. Very happy to sell that and just let the Bitcoin do its thing. I don't care. And I might buy back later in once it finds a new level. I have no intention personally, unless we wake up tomorrow and Bitcoin's $1 million, in which case my base case is that now I can give you an 80% correction. I can't see an 80% correction from here. Right? I don't think we're going back down to 20 or 30K. I think that's very improbable. If we go to $1 million, just like in a big green candle, now I can construct an 80% without too much trouble, right? The bull market will author the bear that follows.
What if it goes to 2 million?
What if it goes to 2 million? I mean, that's very exciting, but I think it probably, then now I can construct a 99 for you, right? So it becomes much harder to stay there.
Yeah.
So, unless Bitcoin does something like that, I'm not personally, for me, I don't care about selling the top and trying to buy back in lower. I'm a Bitcoin accumulator because it's my long-term savings. My goal has not been realized because my goal is housing and education and kids priced in BTC terms. And I don't need that money anytime soon. So know who you are and set your goal. And set it now before the bull goes vertical.
Yeah. And how do you think about, black swan events like FTX and how that plays in with your base case analysis? If everything goes normally, plods along, people start to sell at a certain point, it comes down. If there are systemic risks that show their face along that way, how do you adapt to those things happening?
Sure, and I think there's three that come to mind that are worth just kind of flagging and talking about. They all have various odds of happening. There's obviously a lot of these treasury companies buying Bitcoin. Now, my base case for these, I think Strategy has hit a escape velocity. I think they're a very interesting firm, and the reason why is that they're going after the bond market. So their product is not the Bitcoin, in my opinion. Their product is the bonds that they sell, and markets are starved of yield. Basically, it's the first Bitcoin-backed credit firm. Now, they're going to be volatile as anything. I describe MSTR as being like, if you want to get a rush of 2017 volatility, MSTR is going to give it to you. A lot of these smaller treasury companies, that's 2011 Bitcoin, right? They're going to go through big swings to the upside and then just the occasional 98% down every so often. So there's a risk, in my view. I'm not constructive on most of these treasury companies. I don't think there's a lot of leverage in the system, actually, for those. A lot of people seem to confuse leverage with these companies are just selling equity. So really, they're just diluting shareholders. So the stock is the thing that's the release valve. At some point, a lot of those companies, we call it MNAV, basically the premium they have, will probably go below 1, which means that the company is worth less than the Bitcoin they hold. And then they've got two options. They either get acquired by a bigger company that just eats them, in which case shareholders can just get bought out at a fraction of what they paid for the stock, and that's just like a forced sale. The other thing that can more likely happen is they sell the Bitcoin to buy back their stock, because that's going to be accretive. So they, much like miners have always been pro-cyclical. They hodl everything in the bull and they sell everything at the bottom of the bear. I think these treasury companies will be much the same. Now, I don't put this as a black swan event at this point in time. There's not enough debt in the system. It's just going to be the people who are going to get wrecked there are the stockholders, in my view. And again, this is speculation, but that's how I think that plays out. But we may see a big chunk of Bitcoin get puked out at the bottom. Wouldn't surprise me, probably healthy. The other ones that stand out is the centralization of custody. Now, again, very, very small odds, huge ramifications. Where are all these ETFs? Coinbase. They're one single honeypot of an absolute boatload of coins. And I see so many people on Twitter saying, but what if Coinbase is selling paper Bitcoin and they don't actually have the coins? And my very simple response is, the risk isn't that they don't have them. The risk is how many they have. If anything goes wrong with Coinbase's security, that is a curveball that no one's prepared for. We don't want to see that. And the other final one is quantum. Now, I think the view on quantum is it is a risk that we are going to have to deal with as Bitcoiners. In fact, the whole crypto industry is going to have to deal with it. The whole world's going to have to deal with it. I think the doomerism about it showing up in the next 4 weeks is highly overblown. There's only one industry that has more grift than the crypto industry, and that is the quantum industry. No one knows what's true about anything, and what they say is very rarely what it actually is. I think we're a long way away from quantum being a real threat, but it takes a long time for distributed systems like Bitcoin to adapt. And the solutions that we have are highly imperfect. So I think there's a risk of us just being a bit laissez-faire and not quite dealing with that in time, full well knowing that we don't have to deal with that tomorrow. But we do have to start thinking about it now because it's going to take years to implement the solution.
Right, so the cryptography solutions
Correct.
are there to protect it against quantum, but getting everyone on board to adapt.
And then we also have to, there's the key debate about, there's going to be like Satoshi, for example, on the presumption that those coins are lost or that he's dead. He's not going to be able to upgrade to the new quantum-resistant pub key system. So in his particular case, at some point, and everyone's going to have to deal with this, at some point Satoshi's coins are going to move. This is going to happen. And there's three ways it can happen. Either he comes back from the dead and moves them, or his heirs do. Either he moves them, we move them for him, or quantum's going to move them. One of these three is going to happen, given a long enough time frame. Now, the whole system, the Bitcoin network at large, is going to have to debate which way this we go. Now, personally, I fall in the camp where it's the law of the jungle. Those coins are going to move because I certainly am not going to confiscate them for him, because we saw this recently. There was 80,000 14-year-old Bitcoin, right? Last moved in, whatever that is, 2011 or something. So Satoshi era coins. Suddenly they moved. Anyone worth their salt would just assume that they were lost, but suddenly they come back to life. Some dude was actually sitting on them, squatting on those coins, and finally decided to move them. So from my perspective, some people will say that if someone moves those old coins, that it's kind of breaking Bitcoin's security assumption. I actually disagree with that, because he who has the private key has the coins. They may not be the legal owner of them, right? But they are in fact a custodian of them because they have the private key. And if you happen to get that private key using cryptography, using quantum to break the cryptography, then you kind of have the private key. If we freeze or take away Satoshi's coins, we have made the decision to take away someone's sovereignty. If he chooses not to upgrade, that was his decision. Now, the other element to this is that really, why do people not want those coins to move? Price.
Supply, yeah.
Is price really the concern of the Bitcoin consensus layer? I don't think so. The consensus layer is there to make sure that Bitcoin is secure and stable. Now, some people are going to argue that this is a security flaw. I would say they got the private key. So it's actually working exactly as designed. They just acquired the private key via a roundabout way. So price, in my opinion, is not something that I would support changing the base layer for. I'm very much of the view we should have options. So the people who are alive and can upgrade their coins. There's a lot of people who say, Binance and all these exchanges, because they use the same address reuse, that they're going to be at risk. Then be a business and sort it out. Right? Sort your systems out. Because if Binance doesn't upgrade and they get their coins hacked, where's your due diligence? You do a better job. Companies will sort this out. So because it's in their best interest too. So really, it comes down to lost coins. If Satoshi's coins move, there will be a line of Bitcoiners out the door who want to buy a chunk of that stack and just stick it in their cold wallet and say, I've got some of Satoshi's coins. I think they'll auction for a premium, if anything. At the very least, they will auction at the spot price. So, that's the only other black swan. But, you can't really call it black swan because I just literally described these events. So if they're foreseeable, you can't really call it a black swan. Grey swan, I think, is the probably more correct term. But black swans, who knows?
Okay. Anything else interesting that's happening that you...
I think we've gone over quite a bit of interesting stuff, haven't we?
We've covered some ground here.
Yeah.
Well, thank you for everyone who joined us, and thank you, James, for sharing your wisdom with our audience. Obviously there's a lot of depth behind those high-level comments that you're making, and I assume that we've got people who would want to go down the rabbit hole with you and really understand the data. So for someone that wants to follow your work and get a bit more involved, where can they find you?
Yes, so all of our work's over at checkonchain.com. One word, checkonchain. So basically, we've got two products primarily. One's a newsletter, which is via Substack, and we do a written and a video. So every post, we do 2 a week, written and video. Some people watch, some people read, some people do both. So that's usually 2,500 words thereabouts per post, and half an hour to 40 minutes worth of video. Market updates, a lot of the topics we've discussed today. I just try to help people think about these concepts and really slice through all the noise you see on Twitter, because it is a noisy place. People can't understand why the price doesn't go up, and then for me and my subs, we're looking at all the sell side, saying that makes sense. So it just helps acclimatize to what is going on. That's how I try to share my thoughts and just help people think about the world. And the other one is we've got a charting website, which all the charts are free. Pretty much any Bitcoin chart you could possibly imagine. I've been a big advocate for. We've got so much transparent data. It's all like the on-chain side. It wants to be free. It wants to be open source. So really, my time analyzing the market in the newsletter, that's what we charge for. And the charting website's free. So if you want to do your own analysis, go nuts. So
With an emphasis on those 3 charts you mentioned earlier.
Yeah, study the realized cap, work out MVRV and SOPR. We have a masterclass as well as part of the newsletter, just to help people really understand the nuts and bolts. And I try to deliver everything from a very layman's perspective. There is jargon with all this stuff, but at the same time, it's simple concepts. People sell because they're in profit. So show me the metric that shows me when they're in profit, and then compare it to whether they're actually taking profit. And it's not a hard story. You just got to go. It's like going to the gym. Sometimes you got to go and doing the same reps over and over again, but eventually you keep doing those reps, and then suddenly you get results. So that's part of the proof of work. That's how I think about it.
Great. Well, thank you, James. If anyone does want to connect with either Independent Reserve or Check on Chain, I'll share some links around. Again, we'll share maybe those slides that you've prepared. And have a great day. Thanks for joining us.
Thank you.